All right, good morning. For the record, it is December 2nd, 2021. This is our regular business development advisor training, and glad to have everyone on. Today, we get them 2 days in a row. This will be a first, so we'll see how this format actually works of having a carrier on the day before for a agent-facing webinar, and then having them on the next day for our business development advisor training. So if you don't already know them, Brian, Sarah, they're both from Symetra. And we're excited to have them on. This is going to be, as always, this is a more casual conversation, but as we've discussed, one of the things that we're always trying to find out from a marketing perspective is asking the question of why should an agent or an agency have XYZ company within their product portfolio. So that's really what we're going to be discussing and talking about today. And Brian's going to go over, I know yesterday we went over the specifically the Swift term product and spent a lot of time on that. Great information. We may have some follow-up questions from a marketing perspective of, on our end that we talk about, but I know Brian, you're going to go over a little bit more of Symetra's storyline and their product line as well, because Swift term is just one of the things that you're doing. And then we'll go from there. As always, though, this is a smaller group, so please, in this case, if you have a question, interrupt Brian and ask the clarifying question so we can have that discussion right then. I want you guys to have, by the time that we're done here, 2 to 3 value propositions. We already have one with the Swift term of why agents should have Symetra within their product portfolio. So we'll make sure that we nail that down. But without any further ado, Brian, I will pass the floor off to you.
Awesome.
And it is, you take it where you want to go.
Cool. Thanks. Yeah. So yesterday, if you guys were on, pretty much all Swift terms, some marketing ideas on that, just some product details. I'll get a little bit more into the stuff that's relevant to you guys, some of the Symetra story, where we position ourselves, where our products can fit, how we can make it easier for you to conduct business as a whole with Symetra. So starting at the very beginning, I just want to get our kind of the Symetra story out there in case you're not familiar with it. We've been around for a while. We were established in 1957. Talking about the term, if people are familiar with old Safeco Life, that's the Symetra name. Safeco was bought out in the 2000s by Warren Buffett and White Mountain Insurance. We had a very good relationship with him. He got kind of our permanent life platform, switched us over from that P&C side to more of an individual focused life carrier where we had that focus on life. Made some really good progress with him. And in 2016, we were sold to Sumitomo, which is the 4th largest Japanese owned life insurer. So having that Japanese partner has been really, really strong for us. They have over $43 billion in assets. We have a very strong financial commitment from them. And one of the things that we would be remiss not to mention right now is that Japan has been operating in a really low interest rate for a really long time. So as we enter kind of a new interest rate environment in the United States, I think it's important that we have a partner that has already experienced this and that has been used to kind of going through that environment. So they're not shying away. They've actually given us a boost of money in this low interest rate environment. They've shown their commitment to us in that permanent and individual life space. So they've been a great partner carrier for us so far, and we're happy to have them on board. Any questions on that relationship that we have with them? And then in terms of ratings, we're AM Best A, just A's across the board, strong Comdex. So our financials are strong in that sense as well.
That is good to know on that side. Yeah, I mean, I don't know if there's anything else of any good tidbits of with the new buyout and the infusion of money, if there's anything else that we should know that helps the Symetra story. But I think the low interest bite. Let me ask, actually, this is what I was going to ask, because now it's a Japan-based company. Anything changes within the international marketplace on that side?
Yeah, so we have a really strong foreign national program. We actually brought over, if you'd ever written a foreign national case with ING Voya when they were in that space, we brought over Fabian Gonzalez to head up our program. Our nexus requirements for foreign nationals are super lenient. So all you need to do to qualify is have $25,000 in a US bank account for 30 days and a global minimum net worth of $2 million. So it is a high net worth foreign national program, but the nexus requirements are very, very lenient. Cases can be premium financed. We offer term, and we also offer juvenile coverage for foreign nationals. And one of the good things about having that Japanese partner, Japan is one of those few countries that it's really tough to write nationals of Japan. Only a couple carriers allow that. Since we are Japanese owned, we do allow writing foreign national cases on Japanese nationals as well as French nationals. So Japan and France are two countries that you typically have some trouble with. We're still good to write Japanese and French clients. We're also good with this current environment to write Chinese nationals. There's been some pullback on that, but we are still good to write Chinese nationals in our.
That's good to know. If anybody's in the foreign national space, that's good information from Symetra.
Yeah, so our foreign national program is really, really competitive. In terms of product suite, we offer pretty much IUL is our baby right now. We offer a low cost, death benefit centric protection IUL. So the protection IUL has 40-year guarantees or guarantees out to age 90, depending upon age. That's the sweet spot of it. We had a really strong GUL with the low interest rates that we've kind of put on the sidelines for now, but the PIUL has fit that niche really well. So low premiums will get you high guarantees. If they still want kind of that more guaranteed component out till age 100 or age 120, we can mix and match the premiums to extend those guarantees. But it does have good cash accumulation. You do have access to still 11 different index options. We can get into the index options as we kind of talk through the accumulation based IUL, but the protection product has been really strong, especially for taking over loans. So this is one sales concept that I do want to leave you with. We are very low cost up front. So if you're looking at a 3-pay, a 5-pay, a 7-pay, where somebody wants to dump a large amount in and just wants continuous coverage, the Symetra PIUL is really good at that from a death benefit standpoint. And we're also really good at taking over 1035 policies that have loans on them. So we don't have really a limitation on the size of the loan. As long as we can get the illustration to work, our loan ratio is 95%. I've never run into one that works at 95 or over. So we do have the ability to take loan rescue cases with pretty significant loaned out portions on them.
Nice.
Great. And then the accumulation IUL, our story pretty much remains the same. We're not, we don't really have any bells and whistles in terms of non-guaranteed bonuses shown within our illustration. It's just not the chassis that we were built on. We came to the IUL space pretty late. We saw a lot of what was going on, and we kind of wanted to be away from that non-guaranteed space. So we are low charge, guaranteed bonuses. So we have guarantees built all throughout the accumulation product as well as the protection product. From the accumulation side, we do have very low upfront costs. So if you're looking to kind of have some money in there and you don't want to, so in a premium financing scenario, this is a great space where it works. If you want to keep your collateral obligation low to the lender, the Symetra policy is really great because we have those high early cash values with the lower charges up front. So we're not killing you on the charges. If you do have a couple down years where the S&P or whatever index you're in does zero, you still have pretty good cash returns within the Symetra product. So it's good at helping you out with those collateral obligations, as well as just keeping costs low throughout. So if you're spreadsheeting costs, and we will always show that on the Symetra illustration, but we look really strong from that standpoint.
Okay.
Brian, do those costs change as the policy grows older?
Yeah, so the costs pretty much fall off for the accumulation at year 10. They don't completely fall off. We still have the admin and rider charges, but it is front loaded. So the charges are a little bit heavier up front, but they're still, when you look at the industry as a whole, very low. The one thing that does, it is not necessarily a recent change, but the one thing that does change as time goes on is the premium charge. So in the first year, the premium charge is actually a little bit heavier on the accumulation product than it is in the following years. So if you do, the accumulation product is not as great as taking over like a large lump sum 1035 as that protection product would be. You have a slightly higher premium load in year one compared to the following years, and then it levels off years 2+.
Gotcha.
But in terms of the actual charges of the policy, you'll see a sharp decline in total charges after year 9. So that's kind of the surrender charge period. Once we're out of that surrender charge period, the charges are very minimal on the policy. It's pretty much limited to COIs and I believe about $180 of admin charges per year.
And then does the premium load stop at that point?
So if you're continuing to pay premium, the premium load would go on.
Okay.
Yeah, it was. Yep.
I was gonna say,
But it's on that lower amount that is no longer front loaded, so you still have the lower premium charge there.
that makes sense.
All right, and then in terms of taking money out of the accumulation product, I think this is really a strength of ours. We have a guaranteed contractual variable or participating loan cap that's guaranteed not to exceed 5%. So a lot of carriers out there will illustrate at something where they're showing a full point, or at this point with NAIC rules, a half point of positive arbitrage. Ours is contractually guaranteed not to exceed 5%. So it's really strong for the client when they actually do go to take the money out of the policy. It's transparent. Our mantra here at Symetra is VTS, value, transparency, sustainability. It really does hit that T and the S in that mantra. Transparent and it is sustainable. So you don't have to worry about a loan that maybe you thought was going to be 5% jumping all the way up to 10, 11, 12%, which, as we know, a lot of carriers do have that language built in there where they can kind of vary that loan rate pretty significantly. We're not going to be able to do that, which is great protection for the client when they do go to take the money out of those policies. And
I was gonna say, what year is the participating loan available?
The participating loan is actually available starting in year 1. So we've actually worked cases where there's a large amount of cash value in the policies where loans have been taken as soon as like 60 days after the policy was placed in force. The only thing you can't do in year 1 is take a withdrawal. That would just trigger a boot transaction, but you can take a loan as long as it's structured as a loan and not a withdrawal out of the policy.
Gotcha. What's the current rate?
The current's 5. So the current and contractual guarantee is 5 on the par. And then for our standard loans, you have 25 points of arbitrage. So it credits at 4%, has a charge of 4.25 from years 1 to 10. And then in year 11, it switches over to a wash loan where it credits 4.25 and has a charge of 4.25 on it.
I gotcha.
And then in terms of our index options, so we have a really strong relationship with JP Morgan. So JP Morgan is in a lot of these things. Let me actually pull up our sheet for you because it's just going to be a little bit easier to walk through here.
Yes, something visual.
Yes. If I had tried to bounce around going visual for all those, it would have been a mess. So we're trying to limit it here, but let's see. All right. So these are the options that we have for our accumulation option. We have a base, a core, and a select option. Basically, everything starts in this core account. So the core account is what you're pretty much familiar with. The most common one that we still have is the S&P 1 year core to core. It's a 9% cap, 0% floor, no real bells and whistles associated with it. It was higher a couple of years ago. We hope to make it higher as the interest rate market changes, but that's where we're at right now. We also from there have a buy up strategy and a buy down strategy. So the buy down strategy is a little bit more conservative. Instead of a 9 cap, you have a 7.75 cap. But what happens here is you get a 50 basis point credit each year. So instead of having a 0 floor, we're actually going to up that artificial floor to 0.5%. So you can't get a 0 here, you can get a 0.5. So if you have a more conservative client or an older client that wants to make sure that their money is there and they have a more refined idea of what's going to be there, the base account could be something that's interesting to them. Inversely, we have a buy-up strategy. So instead of the 9, say I want a little bit of a higher return, I have some risk tolerance, the select option could be for that client. This is a little bit more aggressive. Instead of the 9, you buy the cap up to 10.25 and you get a 50 basis point charge. So now instead of a 0 floor, you have the potential to lose 0.5% yearly, but you do have that higher cap. From there, we have the JP Morgan. The really interesting thing about the JP Morgan is that it's completely uncapped and it's guaranteed contractually to be uncapped for the duration that the JP Morgan exists within the Symetra product. The Efficiente, the JP Morgan volatility index that we use, is vol controlled. It tracks 12 different market segments and it has a cash component. So each month they go back, look at the US equity market as a whole, not even just the US equity market, but the market as a whole, has some Forex in there. They go back, rebalance based on volatility, and they typically track around a 5.5% rate of return. Now, since it's a volatility controlled asset, that's why we're able to give you that uncapped access, but we're also able to pass on kind of savings to the client in the terms of a participation rate. So if you look at this, the core strategy, the participation rate on the JP Morgan is 120%. So what that means is if the JP Morgan, if the client's in there, the JP Morgan returns 10% on a 1-year point-to-point basis. Now we use that participation rate, that 10 actually turns into a 12% return. So it's a multiplier on the rate of return that the client would get within the IUL chassis. So all of these options that we're looking at, I'm looking at the accumulation one right now, but we do offer all of these. It's just the numbers get a little bit different on the protection. So everything that we're talking about, the numbers change, but it's the same basic structures for the protection index options as well. And then my favorite, go ahead, Nathan.
I was just going to say, what do you see? You may be getting to this, so I may have jumped ahead, but what do you see as the most popular crediting strategies that are used right now?
So the most popular is definitely still the 1-year point-to-point S&P index. We see a ton of money going into that. Just in my opinion on it, it's just the easiest to explain. Most clients are familiar with the S&P. Most advisors are familiar with the S&P. It's just out of habit, I would say. That's where a lot of the money is going. If you want to go with favorite of these options, this is where I would go to the 2-year blend strategy. So this is that bottom one. It's a 2-year contractually uncapped strategy where you're built up of 50% of your allocations going to the S&P, 50% of your money is going into the JP Morgan. I think the big thing here is you have 50% of that money going uncapped into the S&P. If you look historically, you have a couple of those bull run years that can carry your policy value for a pretty significant amount of time if you catch it correctly. I really do like having the uncapped access to that S&P, and this is one of the few index options within the entire industry that's going to give you some measure of uncapped access to the S&P. So it's really, really strong there. And then you're also getting a 150 par on the JP Morgan. So when we extend the duration and we use volatility, the option cost for us as a carrier is a lot cheaper. So we pass that savings on to the client by giving them that increased participation rate for being in a 2-year volatility controlled strategy. So I'm really high on the 2-year blended S&P and JP. That's what I really like.
No taken.
Cool. And then we do have a couple not brand new, but new strategies, and that is called our AI index. So taking our relationship even like one step further with JP Morgan, I'm just pulling it up real quick here. We started this brand new proprietary index strategy called the AI index. So what the AI index does, it uses the CBOE VIX to automatically look at the US equity market as a whole. So 2 days before our sweep date, we sweep for our policies on the 14th of each month. We're taking a look at the VIX and we're saying, how is the market? Are we in a volatile state? Are we in kind of a more stable state? What can we do for our consumers here? And the number that we've said is kind of where volatility teeters is 16. So if the CBOE VIX is running above 16, we say, hey, we're in a little bit of a high volatility market. If it's below 16, we're saying volatility is pretty low here. We're going to be able to get you into an aggressive strategy. So if volatility is high, we want to control for that volatility. We're going to put you into the JP Morgan. And this is where that AI index comes in. This is something proprietary to Symetra. It really brings active management into an IUL chassis. So there's not really anything else out there that's putting that active management in there. You would have to go back, or the agent would have to go back on a yearly basis, take a look at these things and rebalance annually. The AI is going to do that for them. So this is just a pretty basic illustration of what's happening within this AI strategy. 2 days before we look at it, the VIX is at 16. We're going to put you into the JP Morgan. We say, hey, it's a little volatile. VIX is under 13. We say, hey, market's pretty stable. We can get you some great returns. We're going to put you into the S&P. But what we're allowed to do here, since we're using a measure of volatility, we're able to buy our options at a lower cost. Now, why does it matter that an insurance carrier is able to buy options at a lower cost? It means we don't have to hit a client with a cap or a charge. So since we're getting these at a lower cost, we're passing the savings on again by giving you uncapped access to that S&P. So this isn't a 50-50 blend. This would be 100% uncapped access into the S&P. There is a spread on this. It's 5% for the 1 year, 3% for the 2 year. So we do offer the AI in both a 1 and a 2 year point-to-point strategy. But the returns on these things are really unbelievable. It's a great strategy, and we're happy to have kind of a first of a kind implementation of it. Now, if you look at the actual returns on it, the 1 year with a 5% spread is returning about a 6.6 compared to the S&P with a 9% cap. So it's a full point higher there. But then you get to the 2 year. Now you're able to kind of capture some of those bull run years of the S&P. You have longer exposure and you have a higher par rate. We're able to get that historically up to an 8.79. So you're 3 points higher with physical returns in the past 20 years than an S&P product would have had with a 9% cap. Any questions on that? Because that's kind of a lot to unpack with this AI strategy. But this one, if you're asking where I would put my money, this is, Nathan, the one that I really like is the AI strategy.
Gotcha. And you've seen with you guys rolled this out, what, like last about a year?
Yeah, so it's a little less than a year at this point since it went completely live, but we're starting to see a good amount of people that are getting comfortable with it, putting more money towards it. So we've had a lot of people that had older policies asking to be able to switch to it. That should be live in mid-December. So any policies that are currently in force should be able to take advantage of the AI. And then we have new money that is going into the AI more and more daily, obviously.
That's good to know. Yeah, that's a competitive strategy that a lot of people are looking for right now.
Yeah, and one of the things when we were kind of doing the research on this, and if there's an appetite for it, everybody talks about agent reviews, going in, looking at policy management on an annual policy basis, right? What we found, a lot of people talk about it, but there's not a lot of changes that happen to the index options. So a couple of years ago, 3-4 years ago, we had these caps that were at 11.5, 12% on a lot of the IUL products, right? That's no longer the case, but we haven't really seen money leaving there. Of all of the policies on Symetra's books, only 0.2% of them had any type of index change to their policy so far. So while we talk about a lot of annual review, it just doesn't seem in practice like it's happening all that much. So this is giving kind of that measure of protection to the client. So there is that active management portion there, and it's going to make your advisors' lives easier, honestly. Like they go in, they have kind of that protection. If a client says, hey, this thing's going sideways, what happened? They can say that there was active management there clearly. It's also on a year-to-year basis, if it's a smaller case or if it's a client that they no longer really have contact with. Sometimes that happens, obviously, stuff falls off. you still have a metric where this is being taken care of historically by the insurance carrier, rather than you having to go back and look at your entire book of business on a yearly basis and see if you want to change index allocation. So it's just one less thing on the advisor's plate. And I think it's says a lot about what we're trying to do, just make the ease of doing business with Symetra easier. So we're trying to take over that active management portion of the index.
Perfect.
Cool.
Anybody else have any questions on that? And the AI thing is, I think, is a pretty big deal, especially in the context of the what we just talked about. Is agents typically don't do annual reviews. I mean, the good ones do, but they're not doing the annual reviews within changing historical indices that the clients are in. So having something that's doing that for you, that's a good selling point, basically.
Yeah. And I think this is a really good kind of look back as to what's actually happening within it. So this is just using January data from the past 20 years to kind of show what's going on with the inner workings of this. So if you look at a year like 2011, going into the year, the VIX is at 17.75 the day that we checked the VIX. Now, remember the calculation, we said over 16, it's a little bit volatile. So market's volatile, we put you into the JP Morgan. Well, the market certainly was volatile that year. 2011, you had the zero return in the S&P, but we had you in the JP Morgan because we kind of predicted that volatility, or the AI index did predict that volatility. JP Morgan still had a great year tracking that volatility, did 14.53%. So your client's return, now you don't even have that 9% cap. You actually would get a 14.5 in there. Now, a different year, let's look at 2019. So going into 2019, we had a very volatile metric within the VIX. Now, on the opposite side, where it didn't go zero, the S&P went pretty substantially up. It went at 23.88. So volatility was high. Unfortunately, we had you in the JP Morgan. But is it really unfortunate? Because if you had this 23.88, you would have been capped out at 9 on a typical product, or on a typical IUL chassis. We were able to put you into the JP Morgan. JP Morgan did 11.1 that year. So instead of getting a 9, which you would have in a traditional product, even though you didn't get that 23.88, unfortunately, we were still able to get you into that uncapped JP Morgan and get you an 11.1 rate of return. So it has been really, really strong. And that uncapped access is really what we want to harp on, getting kind of above that 9. Obviously, with the interest rates, it's been tough for insurance carriers to maintain high caps. This is something where it's still giving your client access to that upside, the double-digit returns that could be possible and should be possible within an IUL product.
That makes sense.
Cool. So that's what we got there. Let me just transition real quick to our Swift term, just to hit on that again. Are there any questions on the IUL before we kind of make that transition over to the Swift term? Cool. And then
I was going to say, just Brian, just from a, I'm sorry.
No,
Jeff,
go ahead, Nathan.
No, because I was going a little bit different direction. So you go ahead, Jeff.
The material that you just showed us, is that on that website, the professional?
So that one,
professional?
That one's not. That's actually from a national webinar series that we kind of run around with. It is producer approved, so I can send it to you. It's not going to be out on the website though.
Yeah, if you would, that would be great.
Absolutely. Yeah, we can certainly send that over.
Yeah, send it over to me. I'll include that in our resources, Jeff.
Terrific. Thank you.
And then,
what I was going to say is, so before you get into I'm going to hold the question. I'm going to hold the question till the end. You go into your next thing, Brian.
Okay, cool.
I'm going to get us off the rails if I go down my question.
So we want to get back kind of to that Swift term conversation just a little bit here. One of the things though, before we get into it, is kind of our accelerated underwriting program as a whole. So the question came up yesterday, do you plan to kind of integrate Swift term into this, into your permanent products, that underwriting that we have where we could potentially have instant approval? Our answer to that is absolutely yes. Currently, we already do have a very competitive accelerated underwriting program, and I don't want that to get lost in kind of the Swift term versus the permanent product conversation. So we already have made pretty good strides, and of all the things that COVID was terrible for, I think it was pretty good for us in terms of underwriting. We've been able to get a lot more lenient with some of the requirements that we look for and some of our kind of face amount limitations and underwriting for certain face amounts. So right now, with our accelerated underwriting program, if you're applying for permanent coverage up to $2 million on a client age 18 to 50, you should not need, unless there's some extenuating circumstances, any blood or any microurinalysis. So we still require the part 2. We would just need those types of questions answered, but you shouldn't have to sit down with a paramedical examiner to get the blood, to get the urine. 51 to 60, that coverage drops from 2 million down to 1 million, but that still is what we've seen encompassing a lot of our policies, especially with the new AG 49A regulations and the 7702, where you can kind of dump more money into an IUL product for a lower death benefit to increase that income. That's actually helped us here. You can have the same premiums that are buying less than $1 million of coverage now and still generating great income. So our accelerated underwriting program, 18 to 50 up to 2 million, 51 to 60 to 1 million. I think that's a great thing. And what we've been seeing is some people are so used to ordering APS, or not necessarily APS records, but so used to completing these physical exams, and just when they do the application, just ordering the APS, the paramed from APPS or paramed, whoever their vendor is, that we're getting some that we don't need them. If we do receive it, we have to review it. And we've seen some cases, unfortunately, that it's come back to bite us. But if you do have a case that fits into those parameters, please don't send us the paramedical exam when we don't need it.
That's good to know.
Yep. So this is kind of built on that same chassis, where we're using the MIB records, we're using the script checks, we're using the MVR. So we're able to get really strong offers really quickly here. They don't really have to be submitted any differently. Just keep getting them up through 3 mark. Sandra and Sonia know all about this program. So they'll be able to get that stuff taken care of. There's no like checkbox or anything that you have to say that please put this in the accelerated underwriting program. As long as it fits the parameters, it'll automatically be reviewed as an accelerated underwriting case.
Brian, is that extended for any period of time? So if somebody applies for 500,000 and 6 months from now realizing another $250,000, is there a time limit like a paramed does?
So that's actually a really good question. I don't know if it would reset or if we would just need a supplemental health statement. So with the 6 months, we could probably get by with the sup health statement, just saying that it's good, especially on a one-off. If we had recurring cases where people keep coming back and applying, maybe we'd obviously any interim APS records, but it shouldn't trigger anything where we would need kind of a medical labs until we go over that $2 million threshold. So if they applied for 1.5 this month and then next month they come back looking for 1.5, that's going to be something where we say, hey, now the total line's over 2 million. But as long as we're staying under that $2 million threshold, we shouldn't need the parameds at all. Very good. So then that's kind of the basis that a lot of this, the Swift term underwriting was built on. We were able to get this into our permanent product. So whether you're looking for permanent or term, there should be a non-med, non-blood, non-urine option available for your clients, as long as they're looking for under $2 million of coverage. Now, obviously, the way, if you want to do this on the term platform, is Swift term. Nathan, was everybody on here yesterday? Should I just kind of go through the product overview real quick, or do you want me to recap it?
Do a recap.
Okay. So our Swift term product, it's instant issue term. Clients can have it within 15 to 20 minutes after completing a drop. So agent completes a drop ticket, client answers some questions about their medical history.
Let me hold on. I'll cut you off, Brian. So, because everyone was on the webinar yesterday, do you guys need a recap? Do you guys have questions about the Swift term from you saw yesterday from a marketing perspective? let's change the time for that, because like I said, this information, literally they can go back and recording on yesterday.
Cool.
No, do they take into account other companies, what they have in force, is that taken into account, or is it just a standalone of what they're gonna apply to Symetra?
Could you say that one more time?
Sure, if somebody has an amount in force, is that taken into account for the accelerated underwriting?
No. So it's Symetra standalone. So it falls within, we have a $5 million retention. So all these cases are falling within our internal retention.
Okay.
I suppose just asking on your end, because I know you're talking to other, wholesalers, things like that, IMOs. I know you kind of had that list at the end. What are some of the most successful ways that you've seen of getting agents contracted using, this Swift Term platform? I know PNC is a big place, but is there any other areas that you saw that outside of what you mentioned yesterday that are good ideas for people like Jeff and Jody, that, the marketers that are here, of having conversations with agents to get them contracted to write Symetra business?
Yeah, I think I brought it up yesterday, but the biggest one that I've seen has been accounting firms. So we have a couple larger BGAs that work hand in hand with accounting firms. We have a ton of accountants now that have been contracted, and as we get into the new year, I expect to see a lot more cases being submitted by those CPAs. So that's somebody that obviously has kind of that inner looks into the books, knows that there's a need for life insurance, doesn't necessarily know how to sell life insurance, but knows that they have access to this Swift Term product. It's the perfect solution. So we're seeing a lot of success in that CPA market, and that's not on like a higher level. That's your local town guy that might have a life insurance license, might not, might just have a relationship with you or your agents. That's where we're seeing a ton there, and then mortgages as well. So whether it's a lender, real estate agent, mortgage broker, there's definitely a market there where somebody gets their first time home. They just want quick, easy coverage. You just bought a home. The last thing you want to do is go sit down with a paramedical examiner, right? You just want kind of this to be one all-encompassing sale. You can kind of package that together with the mortgage, say, hey, get this life coverage while you're doing it. It's 15, 20 minutes. You don't have to do anything, instead of 3 meetings with a financial advisor and sitting down with a paramed to get a needle in your arm. So it's just really easy there. I think those are 2 more really good ones. Sarah, any other specific niches that you can think of? I know we have a ton of them. We've done like Chamber of Commerce. We've seen some people do that. We've seen small business loans. It's really all encompassing. Young restaurant owners. So people that don't offer a formal benefits plan. We've seen somebody go in and write a full restaurant group. I think they offered it to like 20 different employees that didn't necessarily have that group life coverage, but it's so cheap that you have access to something now.
Another one too that I've seen is if you're working for estate planning with perhaps parents of clients, we've seen them write their adult children as well too for this. Maybe the adult children don't have the time, they don't feel they have the need to have that full planning. So this would be an item to add for Swift Term to that.
That's good to know. Yeah, those are great. I mean, easy people to find too.
So,
That's it.
Go ahead, Jeff.
no, go ahead. Go ahead.
No, that was it. That was all I was saying.
Are we good?
Whose turn is it?
Yep. Go ahead, Jeff.
Who's on first?
Theoretically, then, if I understood yesterday, the Swift, by going through the Swift Term, the accelerated underwriting, all of your underwriting classifications, whatever they fall in, are available.
Correct.
And full conversion is also available.
Conversion to the specified CAUL product.
Right.
Currently. Yep.
Currently, I don't know if Symetra is going to expand that offering.
Right. Yeah. So we right now, that's the specified product. They do have the language in there where it does say specified. So if they I wouldn't, I guess it would depend upon what our product offerings are in the future when the clients do go to convert. So it would be something within our regular portfolio. We're not creating like a specialty product that's outrageously expensive or anything. It will be something within our actual life portfolio that we
Right,
offer.
but the PIUL and the accumulation is not available for conversion.
Correct, as of now on the Swift term. For our core term, you can obviously convert to it, but not for the Swift.
Oh, well, it's on the recording, but one other quick note, if you're using a credit card, it's $500,000 max per policy.
Yeah, so if you're using the credit card, the death benefit of the policy has to be $500,000 or lower.
But that doesn't stop us from doing multiple applications on an individual?
So it would be $500,000 per life. So once that, it's kind of like that threshold. So if it goes over, that's when it would be cut off. And that's all stuff that's kind of above us with AML rules for the time being.
Good to know.
Very good. And now we didn't really get into this yesterday, but I do kind of want to highlight it just to walk you guys through the process and how it would actually look. And I'll let Sarah pop in here if she has any comments, but just going through what it actually looks like in kind of an end-to-end use of the Swift term platform. So this is what the drop ticket looks like. So when you go into iPipeline or when the agent goes into iPipeline, this is exactly what they're going to see. When I say they need 4 pieces of information, I'm not exaggerating. This is really the agent's only involvement in this entire sale, unless they are walking the client through it or when they start tracking it. But in terms of physical input, it does not really get much easier than this. All of this, your name, that's going to be auto-populated by iPipeline. You have your national producer number, click off the product for Swift term. You have your Symetra producer number, you have the policy issue state, and then you start to put in the client information. So you put in the email, your 3-mark contracting, the affiliation there, and then a back office contact. So whoever you want to get the update emails for you, you just go in, put that in. It's very, very simple. Insured, after you create that drop ticket, is going to get something that looks like this. So it's very, very easy. They get this email that says, welcome, you're being looked at for Swift term life insurance, which obviously they should know at this point. Continue to your application. Nice, super simple user interface. They click that. You can log in with Google. You can generate a PIN, but they can save their progress on the application. So if they're pressed for time, it doesn't really matter. They can save the progress and go back to it later. We're going to tell you when they start the application. So if you see that they started and it hasn't been completed, follow up with a call. Your agent can go ahead and say, hey, what's going on? We saw you started this 2 days ago, but you haven't completed it. They say, oh yeah, I got busy, but it's great to have kind of that relay of information. But again, very easy. You give the consent for the e-signature. This is going to allow your client to just do the e-signature, which is all encompassing. It's going to take care of everything from signing the part 1, that's auto, to the delivery. So everything here is going to be bound into the contract. That electronic consent, pretty important, but very, very easy for the client to use there. We're going to ask them where they're signing at. So pretty much like you would see on a normal life insurance policy, what state, what city. Very, very simple for the client. It's not using kind of that insurance jargon, and we're not having them go through and click on like a sticky note that says sign here, sign here. So just so you guys know, this is exactly how it looks. You don't have to have the client worry about going in, hunting and pecking, trying to find out all this information. It's automatically going to take you there, and it's going to ask it in a nice, simple format. So your name, information, pretty basic stuff there. Sarah, anything I'm missing in terms of like the user experience or going through it so far?
Yeah, just one item I just wanted to mention. This does time out. So there are some clients that will want to sit and wait, although they do have that option. Try to encourage them to complete this in 14 days or less. On day 15, it does time out, and that would require the process, that drop ticket, to be restarted.
Great. And Sarah, is that 14 days from when they open the application or 14 days from that initial email?
When it's initially sent.
Okay, thank you.
And then if they go in there and fill out some information and don't fill it all out, are they able to go, does it save it, and are they able to go back to complete it?
Yep. So it'll auto save. They'll receive like a pin so they can log back in and get it, or they can just link it to their Google or Facebook account even. So that'll save the process, and then they'll just have a link that they can click and continue working on it.
I mean, Symetra's other product lines are phenomenal, but I will say from a marketing perspective, this is a huge, it's a game changer for a lot of the agents. Like, cause I don't know every single carrier, but we spend a lot of time with other carriers. The simplicity of this application for a client is, this is more simple, not to use the same word over again, than other ones that I have seen, bar none. So if you're someone selling term insurance, I mean, this is super easy to use, and agents like super easy. So this is definitely something, you get that value proposition, understand it. I would market this a lot, of why someone should get Symetra as part of their product portfolio. And then of course the other things are great, but I really like this platform. There's a lot of agents that could use this.
Yeah, absolutely. And then with that ease of use, so we obviously talked yesterday about those 3 different pathways. That was a little bit of an insurance-y jargon. This is what the client's going to see when they actually get coverage. If it's instant approval, congratulations, here's some fireworks, you're approved. We're not going to tell them, if you look at this, you're going to notice that there's no standard nicotine. It doesn't get into that health statement. What we found in kind of that pre-trial testing, everybody's super preferred. If you're instantly approved, you're the healthiest person in the world, right? At least in your mind. So if you're a standard, we're not going to tell you. We're just going to tell you, congratulations, you are approved. Don't see an email from us. Contact this person. You will get immediately an email saying, congratulations again, you're approved. You owe us $42 per month or $500 per year. How would you like to pay? So it's super easy. If you do get dropped to that accelerating, which is that light touch underwriting, which is kind of phase 2, you didn't necessarily hit instant. We just want to take a look at it with an underwriter. Thank you. We will get back to you within 1 to 3 days. I think everybody's going to be fine if they apply for life insurance and hear that they're going to be back within 1 to 3 days. So it's not like we're giving you a long horizon there. We're giving you a physical thing, and we're saying, here's a direct contract. So we have a specific team for Symetra. They're going to have direct access to a case manager over there, and they have, again, the access to the insurance agent. So we're keeping the insurance agent in the loop. When this decision goes out to the client, it's also going to go out to that back office contact. So whoever the agent put as the back office contact will also get an email saying, your client was put into accelerated underwriting, or your client was instantly approved, but they're in the loop. They're going to know where the policy is. Now, if it's full underwriting, this is where it gets pretty unique. So with the full underwriting, instead of hitting it like a decline, there's no MIB hit. We're actually going to say, this is going to full underwriting. Here's Mr. Client or Mrs. Client, your option to schedule a medical exam right now. So if they're still interested in pursuing the coverage, they have access to schedule that medical exam right from that offer email from Symetra. So it's really easy to use, very conducive for the clients. So it's pretty great there. Any questions on this? Or Sarah, anything to add to? Because I know you're the expert on all of this stuff.
Don't set the bar
Thanks,
there.
Brian.
We're calling to the experts here, but
Thanks. No, you've covered it all.
all right, great. And then what we were talking about for the credit card. So you have your policy details here. You say, get your coverage. Congratulations. There's the approval. There's the monthly cost. There's the coverage amount. Super easy, not very insurance-y. Looks a lot different than the traditional life insurance ledgers that you might be seeing. We're still going to tell you about your benefits. Nice and easy. Blue box, hit continue. Now, here you go. Payment method. This is what it looks like. How do you want to do it? It really kind of reminds me of ordering something off like Amazon. You have your quarterly, semi-annually, or annual payment option. What do you want to do? Obviously, they know what they want to do. You put in your credit card or your bank information, just like you have done throughout COVID. When you get stuff shipped to your house, you review it, you pay it, and that's it. You get a policy PDF That's the policy delivery. The policy is now in force. So it's really, really simple. Keeps the agent. So if you have somebody that's working in a PNC shop, just wants to wipe their hands of this stuff, that's obviously the number one sale that we're seeing, putting these into the PNC agents' hands, saying you don't really know about life insurance, but you know that somebody needs life insurance. This is the perfect solution for that. Very quick, very easy, very hands off for the agent. It's probably going to be a lifesaver for you guys because it's going to avoid so many agent and application filling out questions. So it's a great ease of use thing, and it's going to take stuff off of your plate as well as the agent's plate, because now with this transactional term business, you don't have to handhold agents for a $300 at the end of the day target commission or anything like that. It's really, really great.
Yeah, I love this. I just don't like the convertibility option there, Brian.
Sure. No, yeah, I understand. And that's probably right now a product of our pricing. So this is where we're capturing market share, right? We just came into this. We got to be the lowest cost. The way to be the lowest cost is you take some of the initial things that you might want in the future, you strip it down. We didn't strip it down in the sense of making it not convertible or not having living benefits on it. That's stuff that we said, no, absolutely can't do that. If you do add on things like a full convertibility, it's going to jack the price up. We are, if you look at us right now and spreadsheet it, typically top 3 in terms of pricing, not only in this instant issue space, but across all term platforms. So on iPipeline, we should be very competitive, anywhere in that $100,000 to $2 million range from a client that's 20 to 50. We're looking really, really strong from a pricing standpoint. So as we move on, I would expect to see changes in the program. But right now, where we're standing in low cost, trying to get the name out there, trying to make people realize that Symetra is a player in this instant issue space, that's where we're at right now.
You mentioned something yesterday. I know it's kind of in the works of having some marketing things, like it sounds, correct me if I'm wrong, where this could be integrated within a website or something like that. Is that correct?
Yeah, so we've had some people specifically ask if they can get kind of hyperlinks. So the hyperlink would say apply now for instant issue term. What we have to work on is getting it to speak with the agent ID and that drop ticket. So there needs to be a way to work with that, but they are working on kind of co-branding. So you can put the Symetra Swift term on an individual agent website or market it kind of as your own.
I mean, that would be an absolute,
That'd be unbelievable.
yeah, that's
Yeah.
in essence of ease of use. Like they can play with some of these, like Ladder and some of these other places that literally that's all they have it on the website, click a button. I would definitely be, it's not there yet. About time frame roughly, like, do you know?
Not sure at all. This is one of those things, like when we came out, we were so focused on getting it out there that obviously it had been thought about, but the drop ticket and how the drop ticket works with iPipeline, I think we would probably have to expand this so we're not completely dependent upon iPipeline in order to get that done. In terms of timeline on that, we really don't have one. Can give you a timeline on like the PIUL stuff that should be the end of the year, where you can get PIUL
That's
coverage
good.
up to for through this program. But in terms of getting the website, I never want to put a timeline on that tech stuff, just because I've given timelines on tech stuff before. That's just still not done. So.
Oh, I totally understand. I appreciate that. No, but that's exciting. All that's on there. This is like, if you guys have any PNC shops that you know of or are talking to, they need to know about this. I mean, we had a couple PNC shops on yesterday, and they instantly wanted to get a contract, and are already talking about putting where they can fit this within what they're doing, because they're already used to that super simple stuff.
Yep. All right, so that's pretty much what I had for you guys today. Nathan, anything else you want me to hit on from a Symetra standpoint, products, portfolio, stuff like that, or?
No.
You have another question. You said that you were gonna hold off.
Oh yeah, the question that I had, that Now I forgot the question, actually.
Oh,
I
man.
didn't write it down. It was more of the idea of going down a marketing path. You kind of actually answered some of it, but just of some areas of answering the question directly of, so what do you see as like the number one or number two reason of why, if you were to boil all this down, of why agents should have Symetra within their product portfolio?
I think it's really just the ease of use. The story, especially, we're sitting at December 2nd right now. If you wanted to get a case in for the end of the year that you want credited, I don't think there's a better company to use right now than Symetra. We have, on our permanent side, we have that underwriting platform where it's not instant, but accelerated underwriting, where you can have a formal offer within 2 business days from an accelerated underwriting standpoint up to $2 million. That's a super easy thing to use as long as you're taking advantage of it. Our customer service slash new business team is fully staffed right now. I know there's been, especially some of these carriers that had like the Washington LTC, they've been bogged down by applications. Turnaround times are pretty slow. We're up and cranking. We have a full staff. We're ready to go to get you guys that business dedicated. So 3Mark has a dedicated underwriting slash case management team. So you're going to be working with the same people, or Sandra and Sonia will be working with the same people consistently. We know which cases are important to expedite. We can get that stuff paid for you. And then just digital, where we have electronic signatures, not just for the Swift term, but we're a completely digital company at this point. IUL, PIUL can all be digital. Policy delivery, e-signatures can all be done virtually. So it's very easy to conduct business with Symetra, and we can get this stuff turned around very quickly for you. So that's where I would say our big value prop is, for not only at the end of the year, but going forward. We just want to make it as easy as possible for you guys to keep your business going.
Absolutely.
So Ryan, did I hear correctly? The ULs are the accelerated underwriting ULs can be applied for that?
Yeah. So for the accelerated underwriting, ULs are, yes, ULs can be applied for that.
What is the distinction then between the Swift term and the accelerated underwriting? What I'm asking is what is the criteria that the underwriting is using that differentiates the two?
So for the permanent product, it's actually being assigned to a physical underwriter. So that's one step of the process. So it's going from the initial case setup to an underwriter. The underwriter is looking at, they're pulling MIB, driver's records, all that history. If there's something they're looking at, an APS, so they can still do that kind of full comprehensive underwriting review, everything except for blood and labs, and then we'll call them non-necessary APSs. So if they did visit, if somebody visited like a cardiologist 10 years ago, but they were obviously clean and we can see that, it kind of allows us to use our better judgment. Whereas Swift term, it's completely computerized up front, where when the client's putting in their information, like their driver's license, we're auto pulling an MVR record. We're having LexisNexis run all this in the background. It's never getting to that stage of a real underwriter's touch. So the accelerated, while it's not instant, it still does have a little bit of personal feel, where we can kind of use some common sense to overcome some of these things. And that's why, so we talked about it yesterday, but after the instant approval, a case would go to light touch underwriting. That's where an underwriter takes a look at something. And that's about 40% of the cases right now. We want to see that, a lot of those 40% going back towards instant, but we need to get the computer comfortable with being a real underwriter. So that's why on the permanent side, the accelerated underwriting, it's still very quick. It's just not instant.
Okay.
And we have, so from an underwriting and from a case standpoint, we have a retention of 5 million, current cap of 20 million that applies for foreign national cases as well as domestic, just till the end of the year, and a premium limit of $1 million for premium right now in 1 year.
Nice. Any other questions anybody has? Jake, questions, Aaron, you good?
Good.
I mean, I think that covers it for the most part. I mean, that, like I said, I'm excited about the Swift term platform. I know the other products are great, but I mean, it's the new mousetrap right now. and it's something I would talk about to agents and agencies ASAP, especially if they're trying to close out anything before the end of the year, because I suppose just ask that question. Contracting, I mean, is there anything that's bogging down contracting? Are you guys on pretty quick with that?
Yep, we have a dedicated, again, Swift Term has their own contracting team. If you have anybody that was kind of at the wheel and says, hey, I get this case that's ready to go today or tomorrow, I'm trying to submit it, just let me know. Me and Sarah have kind of direct main lines into that thing, and we've gotten things turned around in like 2 hours when people need contracting for an application that's about to be submitted. Obviously, don't use us all the time like that, but we do have that dedicated Swift Term team.
Yeah, that's good to know. So, because like I said, we have a couple people right now that I know of that from the webinar yesterday that are interested. But if contracting takes a week, that's gonna, be crazy.
No, it should be 2 to 3 days is my
Nice.
understanding on the turnaround. Yep, and we've seen them done before that, as long as we're not submitting like tons of them.
Yeah, sounds good. Any other questions anybody has while we have Sarah and Brian?
Great. So what time tomorrow?
Hey, I've enjoyed the time, Brian. I mean, I can't speak for everyone else, but I would like to have you guys on again sometime or first quarter of next year. I know there's going to be some more stuff and there'll be some more updates. So I appreciate the time, Brian and Sarah. Always good information. We know where to find you. So
absolutely. Hey, thanks everybody, and let us know if you have any questions or need any help with Symetra.
Sounds good. Thanks, Brian.
Great. Happy
Thank you, Sarah.
season.
Thank you.
Thank you.
All right. We'll
Take care,
stick on a couple minutes, guys, to finish up. But I don't have much else. Is there any other things that you all have now that we're free to talk? We're able to talk freely.
No, it's just that it's interesting that they only limit the conversion right now to the current assumption, because if only 40% are getting through on Swift Term,
Mhm.
the others are either being bumped up to accelerated or full, and their permanent products are available under accelerated. I would imagine it's the same process, same method across the board when it comes to that classification.
Yeah, on the accelerated underwriting side, yeah, absolutely.
So I don't know if it's just a matter of, internal of linking the two to expand the conversion products.
Yeah,
But
yeah. It sounds like
that's where I was going with that.
Yeah, it sounds like that's in the works. I don't know with insurance carriers and like how the back, like I know there's back end stuff. Like to us, it's like, well, just do the thing. Like
push the button.
Exactly.
Yeah.
But yeah, it sounds like it's something they're looking at, because that would be, especially for the Swift Term, that would be, especially from a planning perspective, that's going to be a big deal to be able to convert into an IUL from a Swift Term case. I know you can do that on their other term policies, but yeah, that'd be good to know. But yeah, I mean, I think from that perspective, again, I think we've beaten a dead horse over the past 2 days, but
yeah.
Biggest opportunity, it sounds like very easily P&C agencies. They sell term all the time and they don't care. They don't care about the convertibility. Like they're not worried about that. They're selling the term to sell the term so that it can get done and the client has the coverage, and they want it super easy. They want it super quick. They don't want it complicated. They don't have to deal with the paperwork and things like that. They don't want to deal with the underwriting. This would fall right up their alley.
Oh, and when they get the website connection figured out.
Yeah, I mean,
I'm P&C can put it on their website.
Oh my gosh, that'd be a gold mine right there.
I don't even understand. I mean, I could see P&C agents purchasing a new web domain linked to their previous solely for that purpose.
Yeah,
like to be their brand, but solely life insurance in 20 minutes.
Yeah. Yeah, I could definitely see that. There's a lot of things that have been done on that end. Other than that, though, any other questions?
Guess not.
Like I was gonna say, guess not. Well then, so same bat channel, same bat time next week.
That's where. That is horrible.
Quiet, Jake. We do not have an agent facing webinar the next week. We have it the week after. So that's the one that should be very easy to market. With the title, like, you know, the best way to make a 6-figure case in 2022. I did post the attendee list from yesterday. So you guys pull off the list, take that and see if there's anybody that you had invited or wanted to invite that didn't show up or was there and you want to follow up with them. All that information's right there. So you can go to band for that. But other than that, yeah, I mean, it's we are officially in December, folks. We have basically 3 full working weeks left. And that's about it. 3 full working weeks, that is. Yes. But I appreciate everyone. Everyone have a great rest of the day. Have a wonderful weekend. And we will talk very soon.
Very
Yes.
good. Thanks, Nathan.
Thank
You
you.
guys
Have
are,
a
you guys
good
are
day.
released into the wild. All right, I'll catch you later.
Have a good day.
All right, bye-bye.
Bye-bye.